welcome in. This video is XCN really the next 10X altcoin? We will analyze this. Don't forget to subscribe, like, and please watch till the end to understand.
The formation of such an upward curve structure is actually a very important technical analysis signal that shows buyers are gradually gaining more control over the market. When the price repeatedly touches a certain trend line or curve and bounces upward each time, it indicates that the market considers that area a strong support zone. In such cases, the rising curve almost acts as a roadmap for price movement. The price leans on the curve and consistently generates upward reactions from it. Especially in the analysis of long-term trends, these structures are a very important element of confidence for investors because they show that the market's rise is not random, but is being sustained in a regularly supported structure. If the price touches a rising curve and tends to bounce from it each time, it indicates that buying appetite in the market continues, selling pressure is gradually weakening, and new buyers are entering the system. This situation also serves as strong motivation for investor psychology, since investors see that the trend is not broken and that the price is still in a healthy upward process. The reason we expect the price to bounce off the rising curve is actually a visual reflection of the balance between supply and demand. The curve represents the momentum of the price increase, and the more steadily this momentum is maintained, the healthier the rise is confirmed to be. Therefore, the expectation that the price will touch this curve and turn upward is entirely one of the fundamentals of technical analysis. If the price continues to stay above this curve without breaking it, it further strengthens the signal that the trend will continue for investors, because zones that are tested not once but several times are perceived as strong support. That's why each touch gives investors even more confidence. Buyers enter the market at these touch points, and the price gains upward momentum again. When this cycle is repeated over and over, the uptrend becomes stronger, and a solid belief is formed among market participants. The probability of the price bouncing from a rising curve also directly reflects market dynamics and the behavior patterns of investors. Because market players don't just observe technical levels, they actively trade at those levels. This causes the technical structure to become a kind of self-fulfilling prophecy. In other words, since many investors expect the price to bounce from the rising curve, buy orders increase when it reaches that point, and the price actually turns upward. As long as this cycle is not broken, the market structure is considered upward. In particular, bounces from such rising curves are a sign that the price is rising in a healthy, step-by-step manner. While rapid and sudden rises followed by sharp declines often signal unhealthy movements, prices that progress step by step along a rising curve create a much more reliable bullish scenario. Therefore, the price bouncing from such a curve is proof of a continuously sustained uptrend. The probability of the price bouncing from a rising curve also plays a critical role in shaping investors' trend strategies. Especially for trend followers and long-term investors, these touch points are of great importance for opening new positions or maintaining existing ones. When the price touches the curve, buyers are expected to step in again, and these points are often the beginning of a new rally. Therefore, investors start looking for opportunities when the price approaches the curve. In this way, the harmony between market psychology and technical structure ensures that the price actually bounces from the curve. As long as the price stays above the curve, the market regains confidence, and the belief that the uptrend will continue is further reinforced. If the price continues its rise by bouncing from this curve, the structure itself becomes a guide for the future. Because in technical analysis, past movements have a high probability of shaping the future. If the price has bounced from the curve several times before, this remains a strong piece of data in investors' memory. Thus, at each new touch point, buyers' confidence increases while sellers hold back. This continuously supports the market in the upward direction. The market structure feeds itself through such a cycle, strengthening the uptrend even more. One of the most important advantages of the rising curve is that it gives the price movement a consistent momentum. The curve symbolizes that the price, though fluctuating, is moving upward. As long as the price does not fall below this curve, the uptrend is intact. Therefore, this curve acts as a kind of guide for investors. The fact that the price touches it and bounces proves that the trend is healthy and that buyers see every pullback as an opportunity. In this way, the confidence of long-term investors increases even more. The prices bouncing off this curve is interpreted positively not only for short-term expectations, but also for long-term expectations. because such structures indicate that the price is rising not only with speculative buying, but with truly strong trend support. The price bouncing from this curve actually shows that a new story is being written in the market, that the rise is not a coincidence, but is based on solid ground. This becomes a great element of confidence for long-term investors, because when the market forms a healthy uptrend structure, investors can take positions more comfortably. When the price touches the curve, a bounce is expected because the market sees that point as a strong buying opportunity. When this perception of opportunity is tested and confirmed repeatedly, it becomes embedded in the market's memory and attracts the attention of new buyers. Thus, after each touch, the probability of a rise becomes even stronger. This repeatedly recurring cycle creates a strong uptrend in the market. The expectations of investors and market dynamics feed each other, accelerating the price's rise. In conclusion, in such a rising curve structure, the price touching and bouncing off of it is one of the most basic and most reliable signals of technical analysis. This strengthens investor psychology and shows that buying movements in the market will continue. As long as the price stays above the curve, the trend is healthy, and the probability of the rise continuing is very strong. Therefore, the probability of the price bouncing from a rising curve is always considered a strong element of confidence for investors. In this way, the market structure develops within a framework that supports upward expectations both technically and psychologically. And as long as this framework is not broken, the continuation of the uptrend remains the strongest scenario. But we can't make decisions based on only the curve, so let's also look at other metrics. Stay tuned.
Periods of contraction in Bollinger Bands are considered highly critical and notable signals in technical analysis. This is because when the bands contract, it indicates that market volatility is significantly decreasing and price action is beginning to tighten. Such a consolidation phase often reflects a period in which investors are quietly taking positions, where buyers and sellers are balanced and the price moves within a narrow range. However, this silence is never permanent. Historically, most periods of contraction in Bollinger Bands have occurred just before major and powerful price movements. In other words, this phase of contraction is like the calm before the storm. As the price becomes increasingly compressed between the bands, large players eventually act, supply and demand fall out of balance, and the price makes a sharp breakout either upward or downward. That's why the presence of narrowing bands gives investors the message, a big move is coming soon. It is often difficult to predict the direction of this move in advance, but breakouts that follow a contraction are generally known to be very strong. In other words, when the bands contract and the price tightens, investors expect an inevitable explosion. This is especially meaningful when trading volume is also low, as there is not yet significant buying or selling pressure. In such cases, the price consolidates in a narrow zone and the bands close in on each other almost like a trap. At that point, even a small wave of buying or selling can trigger a large chain reaction. This chain reaction can cause the price to spike suddenly and sharply. By nature, when the price approaches the upper band, it is often seen as overbought, and when it approaches the lower band, as oversold. However, during contraction phases, this classic interpretation should be treated with more caution. Contraction sends a message even more important than overbought or oversold. The market is preparing for a new direction. During this preparatory period, many investors attempt to anticipate the breakout's direction. Some watch volume indicators, while others use momentum tools, such as RSI or MACD, to estimate the likely direction. Regardless of certainty, what is almost guaranteed is that after a contraction, a burst of volatility will follow. From a psychological perspective, band contractions are also significant. Many investors grow impatient when the price is stuck in a range, eagerly awaiting a move. This impatience can sometimes lead to poor positioning. During band contractions, the price can move sideways for a long time, which may bore or frustrate investors. However, patient traders know that every contraction eventually leads to a breakout. Impatient ones often enter a position too early, only to be caught on the wrong side of the move and suffer losses. This is why it's critical to be cautious and wait for reliable confirmation signals when a contraction occurs. Technically, there are clues that may help determine the direction of a breakout when the bands contract. For instance, if the price is forming higher lows within the bands and touching the upper band more frequently, the breakout often leans upward. Similarly, if the price applies more pressure on the lower band, the likelihood of a downward breakout increases. Volume spikes also confirm the direction of the breakout. If the price makes a sharp move in one direction during a contraction and volume rises at the same time, this shows the breakout is real, not fake. On the other hand, breakouts on low volume can sometimes be fakeouts. Therefore, band contractions should never be evaluated in isolation, but in conjunction with other technical indicators. The greatest advantage of contractions in Bollinger Bands is that they alert investors to be prepared. Even if the direction of the move is unknown, an investor can plan stop-loss levels, adjust position size appropriately, and be ready to react quickly in the direction of the breakout. This way, they can capitalize on large price swings. For example, if the price breaks upward after a contraction, the investor can enter early and profit from a strong rally. If it breaks downward, they can short the market and benefit from the decline. Another key point is that breakouts following contractions often mark the beginning of new trends. In other words, after a long period of sideways movement and contraction, once the price breaks out in a direction, it's not just a short-term spike, but can signal the start of a sustained trend. For this reason, many professional traders view contractions as opportunities to catch the start of a trend. These periods are critical because they allow investors to position themselves at the earliest stage of a new trend. This feature of Bollinger Bands sets them apart from many other technical indicators. While most indicators interpret past price action, contractions in the bands serve as a warning of a major upcoming move. This gives investors a unique advantage in terms of timing. If an investor spots a contraction, structures their positions accordingly, and waits patiently, they can make the most of a major price move. Additionally, the liquidity of the market during these contraction periods is also important. If the contraction occurs in highly liquid markets, the breakout tends to be much stronger and more sustainable. In low liquidity markets, however, breakouts are more prone to false signals. That's why contractions observed in large cap coins or stocks with high trading volume are considered far more reliable. In markets where big capital moves, contractions followed by breakouts often form the foundation for long-lasting trends.
The Elliott wave theory is one of the most effective tools used in financial markets to understand price movements and anticipate potential future directions. According to this theory, prices move in specific wave cycles, and each major trend forms through a 5-wave impulse structure. Within these 5 waves, the third wave is particularly the strongest, steepest, and longest in terms of upward movement. This is because the third wave represents the stage where mass participation occurs. Investors confidently enter the market, and technical indicators all signal bullish momentum. At this point, measurements using Fibonacci levels become extremely important in estimating how far the third wave might extend. The Fibonacci 2.272 level is especially critical in this context. When the price reaches this level during the third wave, it often delivers extraordinary returns. If the market has previously initiated a substantial rise from a bottom and completed the first 2 waves, the third wave extending to the 2.272 level implies that the price could increase roughly 10x from its starting point. This signals a major rally in the eyes of investors. The third wave is not only technically significant, but also psychologically represents a phase of increased market participation and nearly uncontrolled upward price movement. The potential for a 10x increase in the third wave stems from Elliott's description of mass behavior patterns. During the first wave, the market initiates a new trend, but most investors remain unaware. In the second wave, a pullback occurs, generating doubts and hesitation among potential entrants. In the third wave, both technical confirmation and increased confidence among previously hesitant participants lead to rapid price acceleration, often surpassing Fibonacci extension levels. At this stage, the price reaching the 2.272 level is not only possible but highly probable according to the nature of Elliott waves. The possibility of a 10x price increase becomes tangible when this level is tested. For example, an asset starting at 1 unit could rise to 10 units with the strength of the third wave. This creates a tremendous profit opportunity in the market. It is crucial to recognize that the third wave is the strongest phase in terms of both time and momentum. Technical tools like RSI, MACD, volume, and trend indicators generally confirm buyers' strength during this phase. Volume in particular peaks during the third wave, as the majority of market participants become active. The selection of the Fibonacci 2.272 level is due to it being a classical target for the third wave. Elliott specialists often consider 1.618, 2.0, and 2.272 as natural targets during the third wave. Among these, the 2.272 level is especially indicative of parabolic rises, as surpassing it often results in accelerated price gains, demonstrating the overall strength of the trend. For investors, this means that substantial returns are possible within a short period. Even if a corrective fourth wave follows such a target, the market typically maintains a strong upward structure, and the fifth wave further propels the trend. This can be viewed positively from several angles. Technically, reaching the Fibonacci 2.272 level confirms the price's strength and validates the trend. Psychologically, this surge attracts new investors and boosts market confidence. Fundamentally, the third wave often coincides with periods of positive news, heightened investor enthusiasm, and accelerated capital inflows. Thus, the 10x potential is not merely theoretical but also aligns with the market's fundamental structure. If the price actually extends to the Fibonacci 2.272 level during the third wave, it not only provides substantial short-term gains for investors but also builds long-term confidence in the market. This movement demonstrates that the trend is progressing in a healthy structure. The price chart typically exhibits a steep parabolic momentum during this rise, which continues to attract investor interest and support sustainable upward movement. Another point to consider is that despite the extraordinary strength of the third wave, early sellers may miss out on potential gains. The possibility of reaching the 2.272 level emphasizes the need for patience. Impatient investors may sell after the second wave, but the largest profits lie within the completion of the third wave. Professional investors therefore never underestimate the third wave and usually prefer to hold positions throughout its duration.
Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analysis, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.